Welcome to our fourth quarter and full year results presentation. Today, Jessica and I will talk about implementation of our Powering Progress strategy. We will provide insights into our strong Q4 and full year performance, and we will tell you how we plan to improve our delivery even further in 2022. A little over a year ago, I hoped that 2021 would be a much calmer year than 2020. Well, it was not. COVID continued to have a major impact. Cost of living went up, supplies across the world were disrupted, all affecting our everyday lives and work. This was challenging, but I also saw great resilience last year, in and outside Shell. Now, extraordinary times call for extraordinary measures, and we made 2021 a momentous year for Shell, from launching our Powering Progress strategy, to simplifying our organization and our share structure. We have strengthened our balance sheet, we provided significant shareholder distributions and invested in the energy transition. So let's look at our delivery, starting with the first goal of Powering Progress, generating shareholder value. We need to deliver shareholder value while we transition to the energy system of the future. And in July last year, we stepped up our dividend to a sustainable and a more meaningful level in line with our cash generation. And in 2021, we also announced share buybacks in the amount of $3.5 billion. And today, we have launched an $8.5 billion share buyback program, and we expect to increase the dividend for Q1 2022. More on this later. We also have made measurable progress with another goal of our strategy, achieving net zero emissions. In October last year, we announced that we will halve our net absolute Scope 1 and 2 emissions by 2030, and this is compared with our base year 2016. Since 2016, we have also made good progress on reducing the net carbon intensity of the energy products that we sold. And in the annual report, we will disclose the energy transition component in the remuneration long-term incentive plans. It will be the first time we do this. The energy transition also requires a change in energy demand. So last year, we started more than 25 sectoral collaborations. So we are working with the car industry, with aviation, the technology sector and others to reduce emissions. A third goal of our strategy is respecting nature. And here we made steady progress in reducing our freshwater consumption in water-stressed areas. And we are working on more than 55 projects in 20 countries, rising to challenges such as reforestation and conservation. Powering Progress also means powering lives, for example, by supporting an inclusive society. And we now have some 30% female representation within our 1,250 senior leadership positions. So I have talked about the progress we made, and you can find more examples on shell.com. But I also want to give you an idea of what this progress adds up to. How does Shell look different today? Now, to start, Shell has become a much simpler business, focused on customers. We have reorganized, and we are on track to reduce around 7,800 jobs and save some $2 billion annually by the end of 2022. That's compared to 2019. And last year, we've also been transforming our business. So in our upstream pillar, we further focused our portfolio, we strengthened our positions in core regions like Brazil and the Gulf of Mexico, while also selling several assets, including the Permian in the United States. And in our transition pillar, we announced divestments of 8 of our refineries around the world, and we are transforming the remainder. In our growth pillar, we are strengthening our leading position in marketing by investing in charge points for electric vehicles and in convenience retail. And we are growing our renewables and energy solutions business by securing access to electrons and expanding our customer-facing businesses. Supporting our customers in their decarbonization journey will require interdependent offerings across our businesses. Offerings that Shell is uniquely positioned to provide, thanks to the integrated nature of our business. So we can offer renewable power, hydrogen fueling, lubricants, as well as carbon capture and storage and nature-based solutions offsets for products that cannot be decarbonized. So for example, from our energy and chemicals park, Singapore, we will focus on supplying our customers in the Asia-Pacific region with biofuels, circular chemicals, bitumen, advanced lubricants and renewable energy. So in 2021, our business became simpler, became more focused and integrated, one that invests profitably in the energy transition. Over to you, Jessica.
Thank you, Ben. This quarter, we've delivered strong results. We generated $11.1 billion of cash flow from operations, excluding working capital movements. Our adjusted earnings were $6.4 billion, mainly due to strong results in integrated gas. The scale and scope of our LNG trading and optimization portfolio allowed us to capture opportunities in the current price environment. However, the ongoing supply issues have not been fully resolved and are likely to provide some challenges in the near term until we bring in additional feed gas supply. As Ben said, 2021 was indeed a very strong year for us. For 2021, our cash flow from operations, excluding working capital movements, was more than $55 billion. And our organic free cash flow was around $27 billion. Our adjusted earnings were some $19 billion for the year. In 2021, we had an underlying OPEX of around $35 billion, delivering on our target and maintaining cost discipline in a higher price environment. This strong financial performance is a result of the way we have reshaped and focused our portfolio over the last years. Through our focus on value over volume, our business has generated around $6 billion more in cash flow from operations, excluding working capital, compared with 2018, when the Brent price was similar. And our capital discipline, combined with solid financial performance, have contributed significantly to reducing our net debt. In 2016, our net debt peaked at almost $80 billion. It increased by almost $16 billion in 2019, when the IFRS 16 accounting method was introduced. By year-end, we reduced net debt to $53 billion, substantially improving our financial resiliency. Our disciplined capital spend, consistent high cash generation, and strong balance sheet provide us with a solid foundation to deliver significant shareholder distributions and lead in the energy transition. The amount we are spending on the energy transition is increasing significantly, improving Shell's emissions profile while enabling our customers to achieve their emissions targets. In 2022, over 35% of our total OPEX and CAPEX spend will be dedicated to producing low-carbon energy, as well as non-energy products for our customers that generate no Scope 3 emissions, and securing solutions for hard-to-abate emissions. We expect our energy transition spend to constitute 50% of our total spend by 2025. Looking ahead, from Q1 this year, we will report our renewables and energy solutions business separately from integrated gas. Oil products and chemicals will be reorganized into two segments, marketing and chemicals and products. The new reporting segments align with our Powering Progress strategy and provide additional transparency in our growth pillar. A critical part of our performance is safety, and here we had mixed results. We've made improvements in some areas, for example in road safety, where in 2021 we reached 1.2 billion kilometers without injuries in Shell-operated ventures. But we had a particularly painful experience in Nigeria this year, when 6 people were killed in a security incident. This brought our fatalities to 8 for the year. Each of these is a tragedy, and while we have significantly reduced injuries and fatalities in the last decade, we must and will do more to reduce the number of serious incidents. From an operational excellence perspective, Shell continued to overcome extraordinary challenges to keep our assets running and our projects moving forward. Despite considerable worldwide supply disruptions, through our unique ecosystem of supply chain partnerships, we moved materials and equipment on time in over 80% of cases, compared with a market average of around 35%. Our recovery from Ida and the U.S. Gulf of Mexico was impressive, achieving a restart across our platforms safely and ahead of schedule. Our project delivery in upstream and integrated gas, including well delivery, continued to lead the industry for 4 consecutive years, according to external benchmarks. As our results show, Shell is delivering, investing, and changing. We are generating strong earnings and cash, bringing real energy transition solutions to the market, while increasing shareholder distributions. And now, back to Ben.
Thank you, Jessica. So we have looked back at our strategy delivery, our transformation, and our strong performance in 2021. Because of our delivery and resilience, I am confident about the future. So let's look ahead. We are accelerating the pace of our shareholder distributions in 2022. And as I mentioned earlier, we have announced an $8.5 billion share buyback program for the first half of 2022. These distributions are around half of our CFFO over the previous 2 quarters. And excluding the Permian-related amount, the shareholder distributions announced for the first half of the year are expected to be in the higher end of the 20 to 30% CFFO range. We also expect to increase our dividend by around 4% for Q1 2022, bringing our quarterly dividend to 25 US cents per share. Following its peak in 2019, our oil production declined by around 8% from 2019 to 2021. And excluding the impact from the Permian divestment, we expect oil production to decline on average by 1 to 2% a year until 2030. And that brings me to our capital spend. We expect our cash capex to be at the lower end of the $23 to $27 billion range in 2022. And the increase in spend from 2021 will be disciplined and will be measured. And more than half of the increase is expected to go to our growth businesses. And with these investments, we will ensure that our financial delivery remains strong in the future, so we can thrive through the energy transition and provide significant shareholder distributions. Thank you.